Joining us now with his outlook for 2024 is Barry Bannister, Stifel chief equity strategist. Barry, thanks for being here. So your prediction for the S&P this year is 4650 into mid-2024. That actually indicates a 3% decline from today's level. So what Bob was just laying out in terms of, the historical chances of, repeating that 20% gain again this year, you actually think it will be declining, at least into mid-2024.
Yeah, we're using 4650 as fair value in the first half. I really don't have the vanity to try to look out to the end of the year. That's just too far out. But we think that the first half will feature a 4650 S&P. The market is simply expensive versus the financial conditions index and the 10-year yield. And we don't really see outside of a recession much chance of the 10-year remaining below 4%.
And in terms of that 10-year, you say there's little downside catalyst other than a recession for the 10-year yield to fall further. Do you think the equity markets agree with that? Because there's been so much interplay this year in terms of where the 10-year yield goes and where the equity market goes.
Well, I heard you earlier reminiscing a little bit about back in the 90s. But if you think back to the early 80s, the first half of the 80s, we had just come off of the 70s inflation. We had in the first 5 years of the 80s a above 10% 10-year yield and a 5% real yield on the 10. There was muscle memory. There was a collective belief that we were going to go back to inflation, which we were not. It peaked in April of 1980. The same thing is happening now in reverse. Too many investors are remembering the 2010s, which was borderline deflationary. A more normal environment, the 10 years should be closer to nominal GDP potential of the United States, and that's 4 and above.
How important, as you look ahead to Friday this week with the jobs number, how important is that in just kind of helping everybody level set for how the market is set up?
If you look at what constitutes the definition of a recession, it's income, production, employment, fixed investment, and sales. The only thing that was not negative last year was employment. In other words, everything else went negative. From the first quarter of 22 to the first quarter of 23, we had a pseudo or de facto recession. The only thing that held on, as I say, is employment, because the job market's just been incredibly strong due to post-COVID effects and other things. If employment starts to weaken, that'll be the last leg. I think that would take down everything. So many of the leading indicators of what is normally a late cycle indicator, employment, are the things that we're watching to know if there is going to be economic trouble in 2024. And until employment shows signs of weakening, I just don't see a recession.
All right. Well, we will certainly be keeping an eye on that, and then earnings starting shortly thereafter. So lots of catalysts to look for. Barry, thank you.